It's a humid afternoon in Bangalore. In a coffee shop on Church Street, Raj sits at a corner table. He works at a boutique advisory firm, and across from him is a founder building a workflow automation tool for logistics companies. The venture is barely 6 months in, but it has a handful of paying customers and a seed round that's almost closed. The product works, and the pitch deck is nearly there. But there's one question that still needs to be answered. Where should the company actually live? Raj's role as an advisor is exactly this. He helps early stage Indian startups decide what to do in this kind of a situation. He helps them work out how to structure themselves for capital, customers, and exits. His job is basically to translate legal geography into survival math. So, he lays out three options in front of the founder. The first is Delaware. It's a default option that every US investor understands. It's backed by a century of corporate case law, and global venture capital has basically memorized its entire legal system. The second is Singapore. It offers a cleaner tax treatment, treaty advantages, and a fund ecosystem Indian founders know as well as the back of their own hands. And the final option is Gift City. It's a financial enclave outside Gandhinagar where companies can operate in US dollars, and it is India's pitch to onshore global capital. In December, its regulator, the International Financial Services Center Authority, or IFSCA, turned 5 and hosted journalists to showcase the entire experiment. When Raj finishes listing these options, the founder comes with his own questions. Like, will US VCs invest here? Can I do a US IPO from Gift City? How do ESOPs work over here? And can I even open accounts on Stripe or Mercury? Raj doesn't answer right away because the honest answer depends on one uncomfortable variable. How much uncertainty can this founder afford? If the founder makes the wrong choice, Raj knows that the consequences won't show up immediately. This founder isn't the only one. Many founders struggle with this choice. To understand the complexities here, my colleague at the Ken, reporter Vali Vikram, spoke to a venture lawyer who advises India US funds. They put the situation quite bluntly. They told her that it's never incorporation that kills a startup. It's the cleanup that happens during Series A, when the founder realizes that their structure isn't compatible with the investors they want. See, for more than a decade, Indian startups have always made the same decision. When it's time to raise real money, they leave for Delaware and Singapore. Eventually, some return to India to list, like Flipkart, the e commerce giant, or Grow, the trading platform. But that solves for the investors' exit, not their beginning. And now, India wants to change all of this. And at the center of the plan is Gift City. Four years ago, in 2022, Dinesh had two tabs open on his laptop. One tab was on Stripe Atlas, the platform that helps startups set up shop in Delaware. Another was on India's Corporate Affairs Ministry's portal. But he already knew which path he'd take. Just a couple of hours after clicking submit, his Delaware parent entity was live. By the end of the week, he had an employer ID number, bank account, and the green light to issue shares. Dinesh claimed that if he had tried this in India, he'd still be collecting documents. Even in Gift City, the incorporation takes nearly 4 weeks. He would be running around for PAN and TAN applications. TAN, by the way, is tax deduction and collection account number, GST registration, provident fund paperwork, and multiple sign offs before the company could legally exist. It's pretty inconvenient because startups are scared of losing time. Term sheets expire in 30 days. A key engineer may try to weigh offers, and pilot customers could be waiting for the company to exist on paper. Still, for Dinesh, Delaware wasn't about just taxes. If anything, the US capital gains can actually be harsher than India's. But what Delaware does offer is speed. He told us that a 4 week delay doesn't just slow you down, it also creates doubt. And that doubt can kill deals. But Delaware also comes with a second advantage. It's just invisible until you need it. It has a judiciary that's built around corporate disputes. The Delaware Court of Chancery handles shareholder fights and board disagreements without juries and with judges who have spent decades interpreting corporate law. Here, outcomes are predictable, and so investors know exactly what they're getting into. Delaware's third advantage is cultural. Global venture capital runs on a shared language. Preferred shares, liquidation preferences, drag along clauses. These structures were born in Delaware and have followed wherever VC culture went. A former Lightspeed analyst told Valli that investors actually expect a Delaware style corporation because that's what their lawyers understand and know best. Especially for US angels who don't have a presence in India, investing in Indian entities feels risky. The PAN requirement means registering with Indian tax authorities. Reporting under FEMA, which is the Foreign Exchange Management Act, adds another layer of compliance. And then there's capital repatriation rules, which is basically the governance of money that leaves the country. The Lightspeed analyst told Valli about an American angel who took one look at the PAN form and joked that he'd rather wire money to Uzbekistan. Dinesh says that if he has Delaware, then he doesn't need to explain anything, and investors just feel right at home. Stay tuned. On a weekday in Gift City, packed elevators stop on nearly every floor. Glass towers are all around, and they're all stamped with familiar names like JP Morgan, HSBC, NSE International Exchange, and more. A financial services CEO told Valli that 3 or 4 years ago there were barely any buildings. Now there are 30 to 35 towers coming up, and his company has moved from an accelerator to a full fledged office. Now, while the dev team works from Bangalore, IFSCA rules demand that some roles have to be physically present. For example, at least a principal officer and compliance head. That is the exact opposite of Delaware, though, which has no such requirement. For firms like the CEOs, Gift City changes the game. 10-year tax holiday, GST exemptions, stamp duty relief, liberalized currency controls that maintain smooth foreign inflows and outflows, and a single regulator, which is IFSCA, replacing India's usual bureaucratic maze. The perks are many. Last year, a Singapore fund relocated to Gift City when the tax rate under India Singapore Treaty dropped to 15%. With Mauritius losing appeal as a tax efficient investment route, Gift City's 10% dividend withholding tax looks pretty competitive. Clearly, these advantages have been attractive. Registered entities in Gift City jumped to over 1,000 by November 2025, from just 80 in 2020. They've accumulated over $100 billion in banking assets. For startups, though, these advantages change into disadvantages. The same regulatory oversight that comforts fund managers becomes a burden young companies can't handle. For example, a few months ago, Raj met a 24-year-old founder from Hyderabad. She was building a fintech product to automate compliance for small merchants. She had a working prototype, angel checks were lined up, and she was ideologically committed to building in India. 2 weeks into the process, she called Raj in a panic. Her lead angel, a former Stripe engineer, was refusing to wire money because the share class template wasn't standard. Another investor was hesitating over unfamiliar ESOP structures. And a US accelerator had rejected her outright. Of course, the founder was heartbroken. It wasn't like her decision was bad, but the ecosystem just wasn't ready to support her yet. See, Gift City has to offer three things that startups need: speed, predictability, and investor comfort. All things that Delaware has offered for decades. More on this in the next segment. Right now, Gift City is actually much closer to Singapore than Delaware. A Kotak banker told Valli that Singapore succeeded as a fund hub long before becoming startup friendly. And even then, only for certain types of companies like later stage ones and holding structures. Gift City seems to be following the same path. The CEO we mentioned earlier says that the problem isn't ambition. It's just that the legal and financial rails that startups run on don't exist here yet. In late 2025, IFSC based firms sent a note to the finance ministry. It was their perspective on what needs to change for Gift City to become a genuine startup jurisdiction. The list focuses on three specific gaps. First, companies in Gift City still follow the Companies Act, which is designed for domestic firms, not venture backed startups. Operators want a separate IFSC corporation code, something that's modeled on Delaware or Singapore that recognizes preferred share structures, venture rights, and ESOP pools. It would allow for fast, fully online incorporation. Second, Gift City has no equivalent to Delaware's Court of Chancery. Operators are arguing for a startup focused tribunal inside IFSC with specialized judges and public rulings that let investors predict outcomes. Third, Gift City has marketed aggressively to banks and funds, but not nearly enough to founders and investors. So, what Gift City really needs right now is to have conversations with Y Combinator, conduct US VC roadshows, have standardized legal templates, and visible early startup success stories. Now, there are early signs. Singapore based payments provider called Brook Bond took an IFSC license and plans to build a large on ground team. Gift City also allows transactions in 15 currencies, which is an advantage Bangalore can't offer. Also, in mid 2025, an executive education and training firm called XCD Executive Development filed for Gift City's first ever public issue. It's expected to raise $12 million. While these are all great signs, structural contradictions still remain. A US company can raise money from Indian investors, but an Indian company can't easily raise domestic capital through Gift City. The CEO we mentioned before called it absurd. He felt that companies were basically being asked to cut their umbilical cord to India after spending so much time growing here. If these frictions are fixed, then Gift City can become India's true international capital market. Companies from Bangalore, Hyderabad, Noida could all raise global capital right from home. But if Gift City doesn't fix its issues, then it ends up succeeding but at the wrong job. Conversations like the one Raj was having with the founder in the Bangalore coffee shop will keep happening. In different cities, maybe, and with different advisors and different companies. But the answer to the question of where the company should live will stay the same. Not here and not now.
Daybreak is produced from the newsroom of the Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription offers daily long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the Ken website. Today's episode was hosted and produced by my colleague Rachel Varghese and edited by Rajiv Sien.